The check engine light just turned on for the entire global banking system, and nobody noticed it yet. A massive $1 billion default has just hit the auto industry, signaling a catastrophic supply chain collapse. The company at the center of this storm is not a household name, but its products are everywhere. First Brands Group, the giant manufacturer behind FRAM oil filters and Trico wiper blades, has officially collapsed. This is not just a standard corporate bankruptcy, it is a massive financial scandal involving missing billions today. At the heart of this disaster sits one of Japan's largest and most conservative banks, Norinchukin Bank. They are facing a near $1 billion loss tied to a joint venture that nobody was watching. This default exposes deep structural cracks in the global auto supply chain and the shadow banking sector. We are witnessing the unraveling of a complex financial scheme that was built on phantom invoices and lies. The ripple effects of this collapse will be felt in every auto repair shop across the United States. Before we dissect the fraud and the banking fallout, make sure you are subscribed to Finance Truths. To understand this crisis, you must first understand the massive scale of First Brands Group in this industry. They are the unseen titan of the automotive aftermarket, supplying essential parts to retailers like AutoZone and Walmart. For years, they grew aggressively by acquiring famous brands, funded by cheap debt and complex financing structures. But beneath the surface of this manufacturing empire, a massive financial black hole was quietly growing larger every day. The collapse began when creditors started asking simple questions about the collateral backing their massive billion-dollar loans. They discovered that the accounts receivable, the money owed to First Brands by customers, were largely fabricated or double-pledged. This is where Norinchukin Bank enters the story, through a little-known joint venture called J.A. Mitsui Leasing. This venture, specifically a unit called Katsumi Global, had extended massive credit lines to First Brands for operations. The exposure is staggering, with court documents revealing a risk of $1.75 billion. This makes the Japanese joint venture the single largest creditor in this chaotic and messy bankruptcy case. Norinchukin, already reeling from massive losses in U.S. treasuries, is now hit with this new corporate disaster. The bank is scrambling to cover the losses, which analysts estimate could wipe out $1 billion. This capital destruction is happening at the worst possible time for the Japanese banking giant's fragile balance sheet. But the real story here is the alleged fraud that allowed First Brands to borrow this much money. Creditors claim that the company created phantom invoices to secure loans against sales that never actually took place. They allegedly sold the same invoices to multiple lenders, effectively double-dipping on the same collateral for cash. This practice, known as double pledging, is the cardinal sin of asset-based lending and constitutes massive financial fraud. When the music stopped, lenders realized there were multiple claims on the same pile of non-existent money. A forensic investigation has reportedly found that over $2 billion in funds have simply vanished into thin air. This missing money has left sophisticated lenders like Norinchukin holding the bag for assets that do not exist. The scandal is being compared to a Ponzi scheme within the corporate debt market, shocking seasoned investors. It raises serious questions about the due diligence processes at these major global financial institutions and banks. How did a Japanese agriculture bank end up with $1 billion exposure to a U.S. auto parts maker? The answer lies in the search for yield that pushed conservative banks into riskier corners of private credit. They chased higher returns in the shadow banking market, lending against assets they did not fully understand. Now, that risk is realizing in the most painful way possible, triggering a massive wave of panic. The bankruptcy filing has frozen the flow of goods and payments, causing chaos in the auto supply chain. Retailers like Walmart and AutoZone are reportedly withholding payments, unsure of who actually owns the valid invoices. They fear paying the wrong lender and being sued later by another creditor claiming the same debt. This payment freeze is starving the company of cash, threatening to shut down factories and halt production. If FRAM stops making oil filters, the entire auto service industry faces a critical shortage of essential parts. Mechanics cannot fix cars without filters, and drivers cannot drive safely in rain without working wiper blades. The physical supply chain is breaking down because the financial supply chain has completely snapped and failed today. We are seeing the real-world consequences of financial engineering gone wrong, impacting the cars you drive daily. The First Brands collapse is a warning signal for the entire $1.7 trillion private credit market. It shows that the golden era of unregulated shadow banking is ending with a massive wave of fraud. Investors who poured billions into these private credit funds are now wondering what other bombs are ticking. If a boring auto parts company can hide $2 billion in fake debt, who else is lying? The contagion fear is spreading from Tokyo to New York as bankers frantically review their own loan portfolios. They are looking for other First Brands in their books, terrified of finding more phantom collateral and fraud. This is a classic Minsky Moment, where a long period of stability leads to reckless borrowing and eventual collapse. The auto industry is just the first domino to fall in this new cycle of corporate defaults. We're likely to see more zombie companies fail as the cost of debt remains structurally higher. Norinchukin's pain is a symptom of a much larger disease infecting the global financial system right now. The bank has already announced a capital raise to plug the hole left by its bond losses. Now, they must find even more capital to cover the crater left by the first brand's disaster. This puts immense pressure on the Japanese financial system, which is already struggling with a weak currency. The yen carry trade, which fueled so much global speculation, is unwinding and revealing these hidden toxic assets. But let's return to the specific mechanics of the fraud, because they are truly breathtaking and brazen. Court documents allege that First Brands used a complex web of subsidiaries to obscure its true financial health. They moved assets and liabilities between entities, making it impossible for lenders to see the full picture. This opacity allowed them to borrow billions more than they could ever repay, fueling a debt-fueled spending spree. They acquired competitors at inflated prices, building a monopoly on essential auto parts while drowning in massive debt. The strategy worked as long as cheap money was available to refinance the loans and hide losses. But when interest rates rose, the scheme collapsed, leaving lenders fighting over the scraps of a broken company. The Katsumi joint venture is now in a legal battle to recover whatever pennies on the dollar remain. They are fighting against other creditors, including major U.S. hedge funds, for control of the remaining real assets. It is a messy, expensive, and public fight that exposes the incompetence of the risk management teams involved. The sheer size of the loss is forcing Norinchukin to rethink its entire international investment strategy and operations. They are retreating from foreign markets, pulling liquidity out of the global system at a critical time. This withdrawal of Japanese capital will make it harder for other U.S. companies to borrow money and grow. The credit crunch is real, and it is being driven by disasters like the First Brands collapse. You might think this is just a Wall Street problem, but it affects Main Street directly and immediately. When suppliers go bankrupt, costs go up, and availability goes down for the products you need every day. We could see shortages of specific oil filters or wiper blades in the coming months at stores. Prices for car maintenance will likely rise as shops struggle to source parts from reliable, solvent vendors. This is the inflationary impulse of a supply chain shock, hitting consumers when they are already hurting bad. The efficiency of the just-in-time delivery model is being tested by a just-in-case financial panic and crisis. Companies will now demand stricter payment terms, slowing down the velocity of money in the auto industry. Trust has been broken, and rebuilding it will take years of transparency and painful financial restructuring work. The First Brands saga is far from over, with criminal investigations likely to follow the bankruptcy proceedings. Authorities will want to know who authorized the fake invoices and where the missing $2 billion went. Executives could face jail time if the allegations of massive fraud are proven true in federal court. But for the banks, the damage is already done, and the losses are realized on their books. Norinchukin serves as a cautionary tale for every lender chasing yield in the opaque private credit markets. They bet big on a safe industry like auto parts and lost $1 billion in seconds. It proves that there is no such thing as a safe investment when fraud is in play. The auto industry is bracing for impact, waiting to see which supplier will be the next victim. This is not an isolated incident. It is a symptom of a credit cycle turning dangerously negative. As we move deeper into this story, we must examine the specific fallout for the Japanese banking sector. How much more pain can Norinchukin take before it requires a government bailout to survive the year? And what does this mean for the stability of other Japanese banks with heavy exposure to U.S. debt? The answers are disturbing and point to a systemic crisis that is just beginning to unfold globally. We will explore the connection between this default and the broader Japanese whale bond dump in detail. The two events are linked by a common thread of mismanagement and excessive risk-taking by desperate bankers. Understanding this link is key to protecting your own wealth in this volatile and unpredictable financial environment. The combined weight of these two massive financial disasters is threatening to sink the Japanese banking giant today. Norinchukin is fighting a war on two fronts, battling bond market losses and corporate fraud simultaneously now. The $63 billion bond sell-off we discussed earlier is directly linked to this unexpected credit collapse. They are liquidating safe government bonds to raise the cash needed to cover these toxic corporate loans. This forced selling drives up interest rates in the United States, making mortgages more expensive for everyone. It is a vicious feedback loop where a Japanese bank failure hurts the American housing market immediately. The First Brands default is accelerating this liquidity drain, removing a key buyer from the global markets. Japanese banks have historically been the largest foreign buyers of U.S. debt, supporting our government deficit spending. If they retreat from the market to lick their wounds, the cost of borrowing will skyrocket globally. We are watching the Japanese whale, harpooned by bad debts, thrashing in the water and causing waves. But the damage to the physical economy is just as severe as the damage to financial markets. First, brands' factories are reportedly running on fumes, struggling to pay for raw materials like steel and rubber. Suppliers in China and Mexico have stopped shipping components until they are paid for past overdue invoices. This production halt will create a massive bullwhip effect that will snap through the global inventory system. Retailers are currently selling existing stock, but the shelves will go empty once that inventory is depleted. We could see a scenario where simple car repairs become impossible due to a lack of basic parts. Imagine taking your car for an oil change and being told there are no filters available anywhere. This scarcity will drive up the price of vehicle maintenance, adding to the inflation headache for consumers. The used car market will also suffer, as vehicles wait longer for repairs before they can be sold. Dealerships are already reporting delays in reconditioning trade-ins because they cannot get the necessary parts from suppliers. This inefficiency slows down the turnover of inventory, hurting the profitability of dealers and auto repair shops. The First Brand's bankruptcy is a perfect storm of financial fraud meeting a fragile global supply chain. It exposes the danger of allowing a single company to roll up so many critical auto brands. Monopolies create single points of failure, and we are witnessing a massive system failure right now today. The private equity model of buy, strip, and flip has left these essential manufacturers weak and overleveraged. They extracted cash for dividends instead of investing in resilience, leaving the companies vulnerable to any shock. Now the bill has come due, and the employees of First Brands are facing an uncertain future. Thousands of manufacturing jobs are at risk if the company is liquidated rather than reorganized in court. The pension funds that invested in the private credit debt are also facing significant write-downs and losses. These funds manage the retirement savings of teachers and firefighters who will ultimately bear the financial pain. The First Brands debacle is a stark reminder that yield does not exist without significant hidden risk. Investors reached for yield in the private credit market and grabbed a live wire of financial fraud. The opacity of private markets allowed this fraud to fester for years without any regulatory oversight at all. Unlike public companies, private borrowers do not have to disclose their financial statements to the general public. This lack of transparency makes it impossible for outsiders to assess the true health of these borrowers. Norinchukin trusted the credit ratings and the loan documents, failing to verify the underlying assets were real. It is a failure of trust but verify, the golden rule of lending money to corporate borrowers. The bank is now conducting a comprehensive review of its entire loan book to find other problems. Market rumors suggest they are looking to sell off other private credit positions to reduce their risk. This fire sale of assets will depress prices in the secondary market, hurting other lenders and funds. We are seeing the early stages of a credit contraction, where lenders pull back to preserve capital. When credit contracts, the economy slows down, as businesses cannot borrow money to invest and hire workers. The First Brand's default acts as an accelerant for this slowdown, pushing the economy closer to recession. Auto parts are a bellwether industry, signaling the health of the broader consumer and manufacturing economy today. If people are cutting back on car maintenance, it suggests that household budgets are under severe stress. The fraud at First Brands covered up this weakness, painting a false picture of growth and profitability. Now the truth is out, and the picture is ugly for everyone involved in this messy saga. The legal battle over the company's assets will likely drag on for years in the bankruptcy courts. Lawyers will bill millions of dollars to unwind the complex web of shell companies and phantom transactions. Meanwhile, the banks will have to write off the loans and move on, accepting the permanent loss. But for Norinchukin, moving on is not so simple, given the sheer scale of the financial damage. The billion-dollar hit wipes out a significant portion of their annual earnings and threatens their capital. Rating agencies are already reviewing the bank's creditworthiness, threatening to downgrade their debt to a lower tier. A downgrade would increase their cost of funding, making it even harder for them to recover profitability. This is the doom loop that traps banks when they make catastrophic errors in risk management judgment. The only way out is to shrink their balance sheet, selling assets and cutting off new lending. This shrinkage is bad news for the U.S. economy, which relies on Japanese capital to fund growth. We are witnessing a deglobalization of finance, where banks return to their home markets to survive crises. The retreat of the Japanese banks leaves a vacuum that American banks are not ready to fill. U.S. regional banks are still recovering from their own crisis and are in no position to lend. The result is a credit crunch that will hit small and medium-sized businesses the hardest this year. First Brands was a large company, but its failure will kill many smaller suppliers down the chain. The trucking companies that move their goods are not getting paid for shipments delivered months ago today. The packaging companies that made their boxes are sitting on unpaid invoices worth millions of dollars now. This contagion risk spreads the pain far beyond the banks and into the real physical economy. It is a reminder that finance is the circulatory system of the global economy, moving essential capital. When the heart stops beating, the organs begin to fail, and right now the patient is critical. The First Brands default is a cardiac arrest for the auto parts sector and the shadow banks. Defibrillation in the form of bankruptcy protection may keep the company alive, but it will never recover. The brand equity of FRAM and Trico has been tarnished by the association with fraud and bankruptcy. Competitors will swoop in to take market share, leaving First Brands as a hollow shell of itself. But the winners in this tragedy are few and far between, while the losers are everywhere today. Norinchukin serves as the ultimate loser, a cautionary tale of what happens when you ignore risk management. They are paying $1 billion tuition fee to learn that private credit is a dangerous game. As investors, we must learn from their mistake and look closely at what is in our portfolios. Do you own funds that invest in private credit or opaque corporate debt without knowing the risks? Now is the time to ask hard questions and demand transparency from your financial advisors and managers. The First Brands collapse proves that even the biggest banks can be fooled by sophisticated corporate fraud. If they can lose $1 billion, you can lose your savings if you are not careful. The era of easy money covered up a lot of sins that are now being exposed daily. We are entering a cycle of truth where bad debts are purged and asset values are reset. It will be a painful process, but it is necessary to restore health to the financial system. Watch the auto parts aisle at your local store for the visible signs of this financial crash. When you see empty shelves, remember the Japanese bank that lost $1 billion to phantom invoices. It is a real-world example of how financial engineering destroys real value and harms the economy. Stay vigilant, stay skeptical, and keep your eyes on the warning signals flashing in the bond market. The First Brands default is just the beginning of the great unwind of the private credit bubble. We will continue to track this story and the broader banking crisis as it develops in real time. To stay ahead of the coming financial storm, you need the truth that the mainstream ignores daily. Make sure you subscribe to Finance Truths for the latest updates on this unfolding global economic crisis.